Welcome to the Broken Pie Chart Podcast, episode 225. I'm your host, Derek Moore. Back with me is my semi-permanent, almost permanent co-host, Jay Pestrichelli, CEO of Zega Financial. How you doing, Jay?
Good, Derek. Glad to be back. Thank you for giving me a week or two off. I really appreciated the time and for clarity.
Yeah, no, it was good.
I don't even know what that means.
I don't know either, but yeah, Mike and I covered some good ground last week as well. International has really surprised. But let me save that because I want to bring that back. Jay, this week, your buddy and mine, Jay Powell, they didn't do anything, but they talked really tough. Jay Powell came out and said, we're going to raise rates 2 more times and we're not going to lower. And we still need to raise rates and we're going to do it, but we're not doing anything now. We're not doing anything. Talking tough, not doing anything, Jay. Thoughts?
I mean, it's like everyone said this was a hawkish pause compared to last time that it was a dovish raise. Like, what is this? What are we like making up all this? They didn't raise. But I get why they have to talk. Like their tools are, we can talk about doing something and then we could do something. That's it. That's it. They could, change rates or they could talk about changing rates. And so, look, they stopped. I feel like inertia is a real thing in the market, right? Trends and inertia in the markets matter. And it would have to be pretty bad news for them to start up again. I do think they've told us don't expect a cut anytime soon. The market for a long time didn't believe them. I think the market is starting to believe them, but that they won't cut. But turning around and raising again once you've stopped, I don't know. Like what made them pause this time? Why? Because the market thought that was most likely. Why did they pause? I don't know. What would make them start again? I don't know. So it's a lot of rhetoric. I think you have to look at what their action was. The basic gist is they paused. The 10 months in a row of rate raises has now stopped, or 10 meetings in a row of rate raises has stopped. That's it. That's what you take away from it.
I'm not sure they weren't afraid of causing more problems in the banking sector. I haven't looked at it. It just, the first thing that came to my mind. The other thing that came to my mind, Jay, was that their dot plots and what they say will happen never happens. They're never right. Just go back and pull up the dot plots from 2018 when they said, oh yeah, rates are going to be up to 3.5%, 5%. No, it never happened.
Yeah. I mean, if you listen to them, last time, right, you should have expected more raises. But then over the last week and a half, leading into the meeting, something changed. Maybe it was like a week and a half. And then they just decided not to. So I'm glad they kind of make decisions with current data and aren't whatever. I don't know what they're using, but because inflation's not gone, right? So I don't know why they stopped. But you're right, Derek. Like they're no better at predicting what's going to happen than any other investor, right? Now, I do think there's been a lot of talk lately around the Fed may have successfully negotiated and navigated a soft landing. Maybe. But I don't think they had really all that much to do with it anyway. I think they caused a lot of turmoil in the first place, and it hasn't really impacted. I think the inflation is just kind of fixing itself, right? Like it will over time. Getting it from 4% down to 2%, that'll be the hard job. So I don't know. I'm with you, Derek. Like they're not going to be great at predicting it and predicting what they're going to do themselves. So I think they follow a lot of what the market pushes them to do, and the market was telling the world they weren't going to raise, and they didn't raise. I don't know. Is it the tail wagging the dog? It's just so unclear. Actually, Derek, it's so unclear that I'm not sure it matters anymore. You want to comment on that?
Well, internally, we were sort of all talking, and I think we were going around the room and people are saying what they think CPI would do. And I said, none of this even matters. It doesn't matter. It's insignificant at this point because the market's moved on. Remember, I always say Greece's debt to GDP was out of control. It was the biggest problem in the world. It's higher than it was 14 years ago, but nobody talks about that. I think this was all code. The reason why they're sitting there and they're saying all this is Jay Powell is looking into the camera and telling everybody, If you start buying useless crypto coins, go out and buy 7 condos, sell your house to buy 150% of GameStop. If you start messing around and speculating too much, we'll do it. We'll do it, market. We'll come back in and raise rates and crush all your dreams. I think that's what they were saying by this tough talk. Maybe not. I don't know.
Crush all your dreams. Woo. All right. If that's what you think they were saying, I mean, he was scolding the market a little bit, but yet he paused. So, talking out of the other side of your face. Maybe that's a Jersey expression.
But we've both said the Fed didn't do anything to break inflation. I don't think they did. And you've made the comment in the past that maybe the Fed raising rates is keeping inflation high, certainly on the core side when you have rents still going up, different things. I mean, talk about that a little bit.
Yeah, so the idea there is, I thought that the Fed successfully slowed down the housing market, right? It came to a screeching halt. Great. So I would say they caused that business to slow down, but the result of that has not been lower inflation. I think the result of that has been housing prices have been remained high. And a lot of it has to do with the fact that people are stuck in an amazing mortgage rate, right? And we've done a show where we talked about individual mortgage rates, and it's hard, you get a lot less house these days when you're going to move because the mortgage rate is 7% compared to the 3 or under that you currently have. And so what's that mean? It means that people are not going to, inventory is going to dry up and prices are going to go up. And it means that people that are buying real estate property to rent now have a higher mortgage and they're going to charge more. So while I think they successfully slowed down the housing market, I think they unsuccessfully caused more inflation in that sector.
I'm going to take it a step further. I don't think this is just a misunderstanding of where the inflation came from. And it's also a misunderstanding that what happens when the Fed does quantitative easing. And when you think about real broadly, what can happen? Well, the Fed can raise or lower rates. They can quantitative ease, which basically means they go out and they buy a bunch of bonds. You can have the government spend more money. The government always is spending more money. Or you can have the government literally shipping barrels of money, not real barrels, but checks. And in the case of the government spending more money, the government is so inefficient that when they spend more money, a lot of it is wasted. It's just a fact, okay? Get over it. It's just the way things are. And then you could have the Fed. The Fed could buy bonds. But think about what happens when a bond gets, they create money and they buy treasury bonds to put on their balance sheet through a bank. The bank had a treasury bond and now they have cash. It doesn't necessarily increase the money supply, or it stays in the banks and maybe the banks just buy more treasuries. But when you actually send physical money, i.e. checks out to people, what happens there is that is actually put into the economy. And that's why, when you look at what the Fed does and what the government's spending more, the government wastes a ton of money. People are much better off spending it. So I think it's just a misunderstanding. And the Fed not, actually reducing their balance sheet or the Fed raising rates, it had nothing to do with it. Jay, what happened this time was so clear to me that at the very point when you have supply side problems, you throw a bunch of money at the problem, which is what the government did and to some extent the Fed did. And it's basically like, here's a gas can. I'm going to pour it in my fireplace while the fire is going. That's exactly what happened. None of these Fed increases are not doing anything. Like if you actually wanted, the drop in inflation is the whole supply side corrected itself. But anyway, Jay, and I want to stop there because I want you to comment on that, but I have more thoughts as well.
Okay, so look, agreed on the gasoline analogy, absolutely, in the money supply discussion. I'll throw a scenario at you. Let's say you're at a economic scenario where you need your credit cards, right? And you need credit. I do think in this scenario, they let's say you've spent your checks that you got from the government, and you're sitting there going, okay, well, look, in order for me to do what I'm doing, and I've created this habit of travel now, and whatever it is, because I had money and now I don't, and you're using a credit card. I do think credit card rates will eventually hit the consumer, right? I do think that someone that's, those folks at some point will realize that, like, I just have to stop the discretionary spending. But I'm not sure we've hit that point yet. But I think you'll first see it in the people that actually, rely on credit for their day to day or their month to month budget. And I do think that will cause some level of slowdown. Outside of that, I'm with you, Derek. Like, the restriction of the Fed hasn't really stopped spending and expansion in this country.
Yeah. No, you're right. I mean, because the availability of credit, things like that, and obviously the banks, the way their balance sheets work and the hold to maturity, all that stuff, that's been talked about ad nauseum. I don't want to talk about it. I'm tired of it. Everybody knows what's going on there. I will say that the Fed creating or the Fed doing quantitative easing does not necessarily, it might increase the money supply, but without velocity of money going up, you don't have inflation. Like, all right, Jay, here's a little quantitative theory of money, monetary quantitative theory. I don't remember which one it is.
All right, let's hear it.
Yeah, like your nominal GDP, so not inflation adjusted GDP. If you want to do your nominal GDP, it's basically the money supply times the velocity of money. So your money supply can double, but if your velocity gets cut in half, you don't have any growth in nominal GDP. So what's happened recently is, I mean, definitely velocity is up a little bit. It had been trending down for years and years and years.
Define velocity, right? So velocity is how many times the same dollar gets spent and circulated, right?
Yeah,
Okay.
I'm going to use a dollar.
Yep,
We're going to pretend that pizza in New York is $1 and a newspaper is $1. So I go in, I buy a slice of pizza for $1. You remember those days? And the pizza owner says, I'm going to take that same dollar and I'm going to go buy the Sunday New York Post and New York Times for $1. And then the newspaper stand guy says, I'm going to take that same dollar and I'm going to go buy a Snapple iced tea. Why a Snapple iced tea? It's what came into my mind because I'm thinking about, New York in the 90s.
You think about walking on Fifth Avenue. I got you. Keep
That's
going.
right. So that same dollar circulated 3 times. But if all what that happened was I bought the slice of pizza for $1 and that money just sat in that register, so the velocity of money is 1 versus 3. And so my point is that when you need velocity to really go up. Like velocity, the calculation is basically your nominal GDP divided by the money supply. That is your velocity. But to bring this back to what I was talking about earlier, let's put it this way. What they literally did was they sent money out. Imagine there's 100 people in line with $100 in their pocket and they're waiting and they want to buy, there's 70 TVs, 90 TVs available, whatever, at $100 each. So somebody's going to be willing to spend a little bit more than $100. But then if you all of a sudden send money out and now there's 1,000 people in line with $100 in their pocket for those same 90 TVs. Well, now the price of those TVs is going to go up because you just threw a bunch of money at it. So the monetary, basically it's your, anyway, I don't want to get too far into it, but it's like, this is all textbook stuff. And it's like, when you look at what happened in the economy, the Fed didn't do any of this. It was just a factor of you threw money into the economy. You had limited number of widgets and people were willing to pay more for it's price times quantity, and the quantity went down and the price went up. It's like, I don't know what else you want me to tell you, Jay. So without going into like a 3-hour dissertation on quantitative monetary theory, I'm just saying the Fed didn't do any of this. They didn't. And the Fed increasing their balance sheet isn't necessarily inflationary. It's why for 10 years, people are like, inflation's coming. No, it never came. Never came. So
it didn't come until supply dried up.
That's right. And then you threw a bunch of money.
Well, yeah, we threw a bunch of money out there, and you dried up supply. You did. There's your gasoline analogy, right? So in your TV analogy, let's say there's half the amount of TVs that there normally is, and people are just used to buying their TVs, right? Well, look, they'll pay up. Hey, good thing I have more money in my pocket. I can go pay up, and that combo did it. And so when we talk about the reduction, like CPI came out this week, PPI came out this week, I guess last week by the time people hear this, and the headline number was 10.1 and the core was 0.4. So it looks like, inflation is trending down, right? I mean, it is when you look at the core month over month over the last year, it's been trending down. But to your point, I'm not sure there has been any real impact of what the Fed has done to do that, right? What caused the inflation is not what they're undoing by raising rates. I think, is that another way to say that? I don't think it is, at least.
No, I think it's right. And if you really want to look at, if you wanted to bring inflation down faster, you would look at the fiscal side. You would look at what politicians do, and they would have people start paying back their loans. And I don't want to get into that discussion, but it's like, yeah, I mean, people would have to start paying back their loans. They've been deferred for a couple of years. There's probably other government programs that are still in place. I mean, I see commercials online. I don't know if it's a scam or not. They're like, get your free cash from the government, for having employees during the last couple of years. So there's other things that they could do. They could pull back money there. But anyway, it's just, I think, it always goes back to when all you have is a hammer, everything you see is a nail. And the Fed, the only thing they can do to fix any problem, and they feel like they have to do something, is they just have to. Now, they haven't crashed the real estate market, but there's no supply. I mean, there's really no supply there. I don't know. So we'll see, Jay. Anything else on that?
No, I think you and I are unfortunately on the same page. We didn't have great, back and forth on this one, but I'm hoping we can get some opposite side discussion. By the way, the last time we had an opposite side discussion on the cost of used cars, I got emails and everybody paid more than what you thought they should pay. I got like 50,000 a car.
Oh yeah, I read those emails on air last week, Jay, where you were gone.
You did?
Yeah, I used first names. And we don't have permission for the last names, but yeah, no, that was great. So send emails. We like emails. Jay,
Yeah,
this is something.
Let's talk about the next topic.
Yeah, we were talking in this week, and this is all a market multiple story. What do I mean by that? Earnings have not gone up much year over year. They're not expected to. And so in 2022, it was all about multiple decline. And that's just a fancy way for saying how many times expected forward earnings are people willing to pay for the market. Because earnings went up in 2022, but the multiple went down. Now, Jay, everyone's willing to pay whatever they want. NVIDIA's going to the moon. Who knows where it's going? But the Fed has been raising rates. And you asked me, when have we ever seen multiples expand, so the forward PE multiple expand, at the same time the Fed was still in a rate hiking cycle? And I said, it's very easy to me. It's 1995. And Jay, I mean, you and I talked about this before. I did a whole episode where I said, is this 1994 all over again? 94, the Fed was raising rates. They continued to raise rates in 95. And then the market was flat in 94, in large part because earnings grew about 30%. We didn't have 30% earnings growth in 2022. The market takes off in 95 while the Fed was still raising. And of course, the market wound up going to, sky high, tech boom, all that stuff. So, Jay, I think one could take, and who knows, this is why we buy and we hedge, we never know. But it's like, to me, could we be setting up for a 94, 95 scenario where this thing is just going to keep going because the multiple is going to expand and people are like, I'm good. So, but you don't think 95 has as much significance as I do here?
Yeah, I mean, look, I hope so. I like the 94, 95 story. And to your credit, you have been definitely talking about 94, 95 for 9 months at least, right? So I love it when you're ahead of the curve, Derek. It's not the first time, so great job on that. And so I hope that's the case. I still think that I'd like to look at things, and it would be great if I did a little research on this, but look at things like the yield of the S&P versus the 10-year yield, right? When you look at things like that, and you kind of look at what the alternatives are that exist to being in the stock market, there truly is an alternative now. I know right now, I think as we're sitting here, the S&P is up close to 10% for this year alone. That having a 5% treasury in your portfolio may not look so great, but a few months ago it did, right? It seemed like the biggest no-brainer in the history of the planet, for me to quote some guy that does advertising on my radio. But it seemed obvious, like just take the safe road. And now it may seem like, oh, I'm falling behind. And on a real basis, I still think stocks are the way to go. You know that. Again, that's why we don't time the market. We invest and we hedge. All of those wonderful things. But when I think about what's happening right now, I just think that there's too many alternatives, safer, significantly safer and less volatile alternatives available in the marketplace today than to take on more risk and to see this expanding multiple, right? So paying up for stocks right now, I'll simplify what I was saying, paying up for stocks right now seems like we've probably seen, to me, a good chunk of that expansion. And I don't see the massive expansion that you saw, that you're referencing for the 95 period, because you have this other alternative. And I know in your example, rates were also going up, but I think there's a little bit of a different scenario today in the bond market than from then. And the rate of change in interest rates, it also means it's a little more significant. So there you go. Listen, I can't argue with the fact that the expansion, the multiple has expanded. Clearly it has. And I do think earnings are going to go up. I'm with that. I just don't think it's going to be the runaway expansion that we saw in 95 through 99.
Give you some numbers here. I'm looking at the 1-year Treasury bill. December 29th, 1995 was about 5.2% was the yield. The start of the year, it started at over 7%. Now, the Fed that year, they were raising rates up through, I think, May. And then they did their first cut. It was either September, October, somewhere around there. So, and we know that typically bonds sort of give a forward amount of guidance, let's say, to the market by what the market is doing in bonds. But yeah, I mean, it's just like when you think about like the Fed, this is a quote, I think somebody on CNBC said, the Fed keeps going until they break something. In 1994, Orange County went bankrupt, partly because they were funding long-term bond purchases with shorting short-term bonds yields, and when yields went up, the whole thing went under. I don't know, Jay. I mean, the other thing that feels a little bit different, but at the same time, is the idea of, okay, is this a new technology now with artificial intelligence? Is it being overvalued compared to the internet in the late 90s that really caused a lot of this run up in the PE forwards, right? I don't know. I mean, I guess that's another thing too. Are people too optimistic about what AI can do?
Yeah. Yeah is the answer. And it's because I don't know the like, where's all the revenue coming from, right? So when you look at who's participating, it's the infrastructure. It's using your analogy, it's Levi's in the gold rush, right? It's selling picks and shovels. Those are going up. Great, because somebody has to provide chips so that AI works as efficiently as possible. Great, I understand that. But companies that make money off of AI haven't. It's almost the opposite of the internet boom in a way where all of a sudden people were betting on the companies that were profiting from the internet, like Amazon, like Yahoo, like the big actually many of them that if I rattled off their names don't exist anymore. But let's just Amazon still exists, so that's a good example. So it wasn't until later that the infrastructure started playing, right? The Junipers, the JDS Uniphase, and then even like FedEx, right? The transports that then did the catch up from that kind of change and global change. When I think about where the revenue is going to come from AI, it's productivity right? Everybody's company will be a little more productive, right? That to me doesn't spur this huge ongoing wave. I still think the infrastructure piece, right? The chip makers and the Google and Microsofts of the world that have actually the AI, great. They're going to do fine. They're going to be able to, I guess, sell the services, right, and then mine that data, right? But outside of that, I don't see it like an internet boom where it's the companies that benefit from the first beneficiaries of it are leading the pack and the infrastructure is behind. Here it seems infrastructure is leading, and we haven't figured out how the revenue is really going to flow to the bottom line of companies. So that's why I think it's different. But I'm not betting against Nvidia. Don't get me wrong there. I think it's great, but I just don't see it as this thing that pulls up the entire market. This isn't the railroads of the 1800s. This I don't think it's the internet. I still think it's great. I'm not against it. I just don't think it's going to pull everything up.
Yeah, I mean, in economics, we call it sort of the production possibilities curve, and that's a fancy way for saying if all you had was a horse and carriage and you need to ship goods, it's the productivity there or the ability to produce things and sell things is sort of constrained. But all of a sudden, the railroads, you can load stuff up and send it all over the country. That's a huge gain. And I think what you're saying is where the really huge gains going to come in AI. I don't know. I mean, you and I have always said like individual stocks are really difficult to pick. I could tell you, if you like Nvidia, buy it. If you don't like it, don't buy it. Like, I don't care. I would say, it's and if you own the market, you have these stocks in there. Like Nvidia's in there. A bunch of these stocks are in there as well. So I don't know. It's always interesting though, Jay, that like, let's say the market's down 20%. Investors and I think some advisors and I think some institutions, their inclination is to sell their stocks. Get me out. I don't want to take any more pain. And then when the market's up 20%, people are like, oh, I don't want to miss out. I want to add more. It's just classic. It's always the opposite, right?
It is. It is. It is. And well, that's an emotional reaction, and what we talk about when it comes to investing in emotions, right? It's they really shouldn't mix. You got to figure out a way to keep those under wrap and be diligent and measured in the way that you make decisions. I like to say this one, right? Have you ever made a decision and said to yourself afterwards, "Gosh, I wish I was more emotional when I made that decision." That rarely happens, and probably never in finance. So yeah, keep that under control, right? Keep the FOMO under control. Keep the optimism in check. And we like to tell people it's okay to exercise, like you said. You want to own some Nvidia because you think it's got another 100 points in it or 500 points. It's going to 1,000. Okay, then have some exposure to Nvidia. I get it. It's okay, but that's a different bucket than your overall growth of what you're trying to do when you're building wealth long term, right? So enjoy those. We love trading; those are fun to do, but it's not the way we do our whole portfolios, of course, right?
I mean, the bull case is that, yes, the artificial intelligence changes everything. The bull case is people are going to be willing to speculate and pay up and have a much higher price to forward earnings ratio. How many times forward earnings you're going to? The other bull case says, well, while the Fed may not lower rates, at least if they stop raising them, it's like, okay, let's just hang out here. That's good. Some of the bear cases I've seen are this is a really good rally, but not, it's all driven by like less than 5% of the companies. So this is from, who put this out? So this is not my work. I saw this on Twitter, but it's titled Beat the Bench. Maybe that's what the newsletter, I'll have to go back and look, but the index and nobody else. And what they did was they put a chart out and they said the S&P 500 future returns have been subpar when less than 5% of its components make a 52-week high with the index. So let me just simplify that.
Yeah, say it again. Like give the two pieces that it's putting together.
Yeah, when less than 5% of components make a 52-week high, at the same time the market is making a 52-week high. All right, that's how I'll rephrase it. So the market makes a 1-year high, 52 weeks, but only 5% of the members of the S&P 500 also made 52-week highs, which means 95% of the index components are not. So really, Jay, this is sort of the breadth is not really good. We're not seeing broad-based 52-week highs here. And what this goes on to look at is some different periods where, so 6/12, 23, the high was 43.40, and percentage of new highs was less than 5%, but it is a 52-week high, Jay. So
yeah, that's why you're bringing this up. Like, by the way, I don't know if everybody knows the S&P is at a 52-week high. Right? We made that on, like you said here, on 6/12. It made a new high. Now it's not an all-time high, but it is a 1-year high, and I think that's important. Some people may not know that this has not been a bad 12-month period if you look at today, right? So sorry. So that's the first reason why I think you're bringing this up, and then the concentration is an interesting characteristic of this new high that we have. Fair to say?
yeah, no, I think that's right. And then they go back to, so 2023, there's stuff in 21, 20. We're not going to read all these. This goes back to 1990. So I don't know what the data would be before then. But the point is, like, okay, when the market makes a new all-time high, what is the return over the next month, the next 3 months, the next 6 and 12 months? And, I think the point of this person who put together this data was that there a lot of times, it's a little bit mixed, but generally the market's up. You've had, 2000, and I'm going to talk about 2000 more in depth with you in a second, but 2000 was where you had, over 20% declines over the next 12 months. In 20, December of 20, it was up 28% the next 12 months. So, and interestingly enough, Jay, the best numbers on this whole thing were 1995. I'm just saying. I have no idea.
You jumped right to it. So let's go through kind of all these periods on this list. There's what here, maybe 30 different times that they call out between 1990 and now. The
Yeah, that's right.
average, yeah, the average return over the next month. So if you take all these different periods, and it's a fairly wide mix. The average over the next month is a negative 0.7. So if we were to do the average from when we made this new high on June 12th, you go to, I guess I'm going to assume calendar month, you go to July 12th, we should expect a 0.7% average pullback because of this circumstance. You go 3 months out, it's a +1. That's good. So, when this occurs, the 3-month average is +1. When this occurs, the 6-month average is +2.3, and the 1-year average is +4.3. Now, I think from the work that you and I have done in different strategies, those numbers are, the 1 month is below average, right? On average, the market is actually up, usually about 1%, just under 1% over a 1 month period. This is negative. 3 months, you and I both know the average is more like 2.5%, 2.8%, and this is only 1%. So just using averages that you and I know on the S&P, when this circumstance occurs, it has been below average, generally speaking. And there's definitely some interesting periods that we could look at here, right? You've got the pandemic 2020 period when this occurred, and a few breakout stocks led the way. The next year was strong, right? 30, 28%. We know that the market was very strong after that period, right? Because 2021 was a monster. When you could look at some other bad periods. Oh, actually, what's another good period? Well, the only other really good, strong period is your 95. So with the exception of 2020, you've got 1995, that those two periods are the ones that pull up. The rest of these numbers are negative or single digits 1 year later. So this is from the bear side of things, an interesting argument, unless they've adopted your 95 similarity theory.
Yeah, this is interesting. I don't know what anybody would do with this, certainly, but I think the point is that, a lot of people, the bear side, are saying, wait a second, this is a great rally. We've come too far too fast, and it's not really broad participation. So if you have these 5% of companies, which in the S&P is 5% is 25 companies, right? If they kind of pull back and the rest of the market doesn't come up, then you would expect the market not to do very well. Who knows what's going to happen? If we knew, we'd have other powers, right? But
Well, let's talk about 2000 for a minute because it sounded like you wanted to dig into that because let's remember what happened in 2000.
yeah, and I'll frame this. Let me frame this, but I want you to kind of take the lead on this. And so I said to you off air before we were coming on, where did this whole once we're 20% above a bear market low, we are in a new bull market come from? Like, why? That doesn't make any sense to me. And there's different ways to look at. You sort of know what a bull market is after it's like, I'll tell you where the bull market is after a bull market's happened. I mean, there's two ways to look at it. One is you can look at the trough low of a bear market and you say, okay, once we know we've troughed, that's when the start of the new one. You could wait a little bit. There's also the cyclical thing where you say, well, we're still not above the old all-time high. And until you can be up money from that all-time high, like until we break that, we're not in a new cyclical bull market. And there seems to be this thought, Jay, CNBC, a couple of people said, it's all clear because we're 20% off the bear market low, and that assumes that was the low. But Jay, 2000 to 2002, I feel like we're getting old and that not a lot of people remember this period. There was some stuff that happened there that sort of, just go into it a little bit, Jay.
Yeah, and I didn't remember all of this. So the point that Derek is making is that you can have significant rebounds and them not be an indicator of a broad-based reversal higher. So in a declining market like we had last year, we did have a couple bounces of like 15%, yet the market continued to press lower, which is why it gave investors a lot of angst, right? The market timers just were even the bears were on the wrong side of that the whole time. So when you look at 2000 through 2002, which we remember internet.com bomb, right? That whole reversal, there were 1, 2, 3, 4, 5, 6, 7 times on the Nasdaq where it rebounded 20% or more, and actually a couple times it rebounded 50% or more, but it did not signal the bottom of the move. That's what Derek wants us to recognize here, right? Where you've got this downtrend and you do have these bear market rallies. There's a term for these. Even when you look at the S&P during that same time period, there's 1, 2, 3, 4 times that the market rallied 20% or more during that overall decline. You had 20% rebounds, and 4 of those did not indicate that the bear market was over. So I think that's the point that Derek wants us to hit home on. Now that I said the data, Derek, I'll give you a chance to comment, and then I'll probably comment why I think you're off base on this.
Yeah,
Not
and by
that
the
I'm
way,
leading wrong.
yeah, and tip of the cap to John Husband had put this out on Twitter, so I didn't create this graph that we're looking at, but. Yeah, I mean, I think the point is, and it always goes back to, if you actually know that that low was the bear market low, then of course you can say, well, that was the low. But you don't really know if it's the low until enough time has passed. And I think the thing, that Husband points out here in this graph is, I'll just use March of 2001. March of 2001, and I remember this. I was trading. I was on a trade desk. It would be very easy to say that was the bottom. If you covered up the graph and you couldn't see the rest of it, you'd say, oh, yeah. I mean, we rallied up 21%. We're in a new bull market. And then by September of 01, we make a new low. I mean, a new lowest low. We actually pierced the low prior to that. And then you rally up 24% again. You're like, okay, now we're good. Like you have no idea until post de facto, is that a word? like whether or not that was a bear market low. So the point of this is, to me, number one is I don't know where this whole once you rally up 20% off a quote unquote bear market low, you're in a new bull market. Like if you look at this, you're like, okay, we're in a bull market. Now we're in a bear market. Now we're in a bull market. Now we're in a bear market. Like, come on, this doesn't make any sense to me.
Well, I don't feel the need to put a label on it, and so I'm fine with not calling what we're in right now a bull market if you don't want to. But I do think so. There's two things that I'll comment on this. I think when we were talking about the 1 year later after the concentration, 2020 ends up being the 1 year later after March of 2020. Kind of bringing back the other conversation for a second, ends up being some of the worst data points on here, right? Minus 23%, minus 20% after March of 2020. So there's a lot of bad data points there. You brought up the similarity of AI and the internet. Maybe that's what happens after if the AI rally reverses. There's so many similarities in this conversation. But when I think about the whole 20% signals the bottom, I agree with you. That clearly is not the case. 2020 is a great example of that. However, those rallies that occurred, Derek, right, those 20% rallies were in fairly short periods of time, and we never got, even in the short term, a set of higher highs and higher lows. So even though these rallies occurred of 20%, they didn't surpass the previous highs of just a month or 2 months before them. Do you know what I mean? So you were clearly in a downtrend in all of this. And I would argue if you were to cover up the left side of the chart in March of 2001, I would say it was not clear that the decline is over. You didn't create, you didn't stop the trend of a lower high and then stop the trend of a lower low. What we're going through right now, Derek, is very different than 2020 and 2022. And I don't know if you're trying to make the comparison between them, but we have been since October in an uptrend of higher highs and higher lows in the S&P. The Nasdaq is it took a little longer for it to get there. It had to start in January, and that thing is a weird parabolic chart, which is just unique of its own. We know that right now. But I do not think this is anything like those bear market rallies of 2000, 2002. Just doesn't feel that way.
Yeah, no, I agree. And I think there's this thing in technical analysis too. It's time matters. And when you stretch moves out over longer periods of time, the bases you build are stronger. The moves have more conviction when you have these very short-term things. And I think you're right. If I pull up a chart of the S&P and I'm like, okay, the market rallied from 3674 June 17th of 2022, so that was last year, all the way up to 4280.15 by August. But that August high was lower than the high in April. It was lower than the high in December, January, December of 21. So I think that's right. And as as a technician, the market now, overhead supply is sort of resistance. And there's, we have some areas now. You have, 45 back in April of 22. This is not how we trade, Jay. I mean, we invest long term. We buy the markets, we hedge. And it's the whole idea is for investors, like you shouldn't get emotional. You shouldn't say when the market's down 20%, get me out. And the same thing, you should already be in. And a lot of people probably are getting in now. But I think your point's well taken, Jay. It's that chart does look a lot different. And time matters there for sure.
Time matters. Yeah. And listen, I we always talk about, our process a little bit about how we buy and we hedge. And we always like to stay invested, but protected. There is a little bit of activity that is associated with being hedged, right? You have to do something with your hedges from time to time, and you have to know when to reset. And so, there are things when we will watch the market move, and there are, price points within the market where we may decide, like, hey, our options have changed and the prices have moved to a level where it's time to re-hedge, or it's time to take advantage and cash in on your hedge. Part of the point about being hedged is to cash in on the hedge when you can, right? Whether you're, reinvesting avoided losses or just taking advantage of the profits on a hedge. It's like insurance, right? You have insurance for a reason. If you have car insurance and you have an accident, you're going to use the insurance. You're not going to say, "Oh, I'll save it for next time." It doesn't work that way. So I thought it'd be interesting, let you know, like, why we still, maybe just to say this out loud, why we still watch the movement in the markets and the pricing of our option strategies is because there are things that you have to do when you're running a hedged portfolio, right? You're not always hedged, right? You're not always hedged the same way. Your hedges, as the market moves up, become less and less valuable because they're farther and farther away. They protect less and less. And so you have to kind of regularly re-hedge and re-engage. And there's probably there's probably multiple shows that we could do about the concept of re-hedging. But I just thought I'd bring it up because we still, even though we always say stay invested and stay hedged, it still matters what the market does for us. And it still matters the way we actually manage those portfolios.
I mean, in general, we want the markets to go up.
We do.
That's what we want for our clients. We want it for the advisors who use our strategies. And it's because you want it to go up. And I think this has been a little bit of a stealth rally. I know it sounds strange to say, but sometimes when I talk to people and I say, you realize the market's at a 52-week high. Really? They still assume it's down. Like it's awful. I'm like, no, it's the market's higher than it was the day the Fed did their first interest rate hike. So, I mean, congratulations, pal. Like, what do you want me to say? All right, Jay.
There you go.
Let's
didn't blow it up. Enough.
Yeah. Good for you, Jay. Not you, Jay Powell. So I did get a note from our friend Michael, a listener of the show. He said he watched Brockmire a couple episodes. He watched it with someone in the family. He laughed his head off. She thought it was gross and over the top. He said, let Jay know. It'd be good to give a little, like a rating or a little heads up if one of your recommendations. So
like give a maturity update. Like I thought I did. I thought I kind of insinuated like that, Michael, that this was a little lowbrow humor, but I definitely didn't emphasize it. I'm glad he enjoyed it. I think the show's hilarious. And my wife does not, by the way.
Jay, do you have anything this week? Anything I know you did some travel. Did you watch anything cool on the plane?
I've been watching a show called Citadel on Netflix, kind of a interesting spy show with kind of twists and turns. I'm not all the way through it, but it definitely has my interest. And then for the Trekkies out there, I'm sure the new season of Strange New Worlds came out this past week, so I'm watching that as well. I
started watching the Schwarzenegger documentary on Netflix. And it was one of those things I put it on and I'm like, let me check it out for a minute. And 20 minutes had passed and I was still watching it. So I think it's kind of interesting. I don't know how many episodes there are, if it was just one and done, but that caught my interest a little bit. Jay, did you wind up going to a Florida Panther game? Your favorite sport, hockey?
I don't remember that we had a hockey team in Florida, so I didn't make any of the games.
Your team was in the Stanley Cup. Not, it's in your team. There's the team on the east side of Florida, which is the Florida Panthers. They play in Sunrise.
Yeah, I'm on the east side of Florida. Yeah, I'm on that side.
So it's Sunrise, Florida. Yeah, so they lost the Stanley Cup Finals 4-1. What always fascinates me, though, about hockey is that once the series is over, you actually find out the injuries. And Florida had apparently 4 guys playing who need shoulder surgery. Another guy played for 20 games with a broken foot and a torn oblique. And one of their stars, Matthew Tkachuk, who didn't play in the final game. The game before, people had to tie his skates and put his uniform on for him because he was playing with a broken sternum. So hockey players are unbelievable how they play through stuff. So
yeah, no, they really are. I know I tease, but wow, what a sport. Unfortunately, I think it's underrated in our country, right? It doesn't make it to the football, basketball, baseball level. But I mean, yeah, I know hockey players, and it's a brutal physical game.
I feel like the NFL players, I feel like sometimes they don't play through stuff. But maybe that's the smarter thing. Maybe they're smarter than NHL players. I don't know. But You know what it is, though? It doesn't translate. So with HDTV, it definitely is much, much better to watch hockey on TV. But there's nothing like being in the arena and watching it live. So anyway, that's no more
I should
hockey.
go to a game.
So
I should go to a game. You should suggest that for me. Really, I don't know why you didn't push harder.
kind of have been doing that. All right, Jay. Well,
all right,
good
Derek.
to have you back on the program, and we'll let you know if that was a bear market rally or a new bull market. We'll let you know in about a year. How's that, Jay? Fair enough?
We should know by then.
I think we should. All right, Jay, thanks for coming on again. Everyone else, we'll see you next week. Take care.